Today, we're taking a first look at one of the freshest faces in the cybersecurity world to go public, Rubrik, ticker RBRK. We're going to cut right to the chase and break down their business, their pretty wild financials, and what it all means for an investor. So let's just dive right in. The entire story for Rubrik really comes down to this one question. Is this thing a rocket ship in a super important industry just waiting to take off? Or is it a company that's just burning through cash way too fast? That's the real tension here, and that's what we're going to explore. So first things first, what does Rubrik actually do? Well, think about all the ransomware attacks and data breaches you hear about. It's a constant threat, right? Rubrik steps in as a sort of digital bodyguard for a company's data. They focus on cloud backup and recovery, so if a business gets hit, they can get back on their feet. So yeah, they're in the business of cyber resilience for big companies. This puts them in a really packed, but also really critical playground with giants like CrowdStrike and Palo Alto networks. And since they're new to the NASDAQ, everyone's trying to figure out if they have the secret sauce to really compete and stand out. Okay, now let's talk about how they make money, because honestly, this is the heart of the argument for the stock. Rubrik is all about subscriptions. They want that sweet, sweet annual recurring revenue. And investors? Oh, they absolutely love to see that. It means the income is predictable, it's stable, and is reliable. And wow, this chart just says it all, doesn't it? Take a look. In their very first quarter as a public company, a massive $172 million. That's like 92% of their total cash haul came straight from subscriptions. That recurring revenue isn't just a part of their story, it pretty much is their growth story. But, and there's always a but with fast-growing companies, that kind of aggressive growth comes with a hefty price tag. For Rubrik, it's a story of two totally different numbers. On one hand, you've got amazing growth. And on the other, you've got some absolutely eye-watering losses. This is the real tug of war in their financials. So let's start with the good news, because it's really good. Just look at that jump in revenue from last year. It shot up 38%, from about $136 million to over $187 million. I mean, this is the exact kind of thing that gets Wall Street buzzing about a new tech company. And now for the other side of that coin. While the revenue was climbing, the company reported an operating loss of $725 million. And get this, that's in a single quarter. This is exactly what we mean by the price of growth. Now, to be fair, a huge piece of this is stock-based compensation from their IPO. But still, that's a number you just can't ignore. And we're not just talking about paper losses here. The company's actual cash flow was negative $37 million for the quarter. Put simply, that means more cash went out the door than came in. It's the classic cash burn situation, and you can bet the bears are watching this number very, very closely. Okay, this is where it gets super interesting, because this slide helps make sense of those huge numbers. By the official accounting rules, or GAAP, their gross margin is 49%. But if you look at the non-GAAP number, it's a much healthier 75%. The big difference? Almost $50 million in stock-based pay. So the bulls will argue, hey, ignore those one-time IPO costs, and that 75% shows you how profitable this business really is underneath it all. So what's the game plan? Where does the company think it's headed? Let's check out their official forecast for the rest of the year. This is basically management telling us how they plan to walk that tightrope between spending for growth and trying to get profitable. So, Rubrik is projecting revenue well over $800 million, which means that strong growth is set to continue. But, and here it is again, they're also telling us to expect more non-GAAP losses and to burn through about $100 million in cash. The key takeaway here is the company is being upfront. The spending isn't stopping, and that's why analysts are valuing them on future sales instead of current profits. All right, this brings us to the final showdown, the bull case versus the bear case. We've laid out all the numbers, we've looked at the strategy, and now it really comes down to how you see it. It's that classic Wall Street story, future promise versus today's reality. So let's just sum it all up. The bull case is all about the promise, right? You've got explosive growth in subscriptions, amazing revenue jumps, and those really attractive non-GAAP margins that hint at a profitable machine under the hood. The bear case? It's all about the price you have to pay for that promise. We're talking deep accounting losses, burning through cash every quarter, and a company that's telling you they plan to keep spending. So is Rubrik the next big thing? A company whose growth is worth paying a premium for today? Or is the road to actually making a profit just too long and too expensive?
That's really the question you have to answer for yourself. And of course, none of this is financial advice. You've always got to do your own homework. But hopefully, this gives you a much clearer picture to start with.